To be joined fuel oil procurement at Euronav, Laurie Haytayamina, Director of the Natural Resources Governance Institute, and Neil Atkinson, former head of Oil Markets Division at the IEA. Welcome, everybody. Thanks a lot for joining us this morning. Neil, if I can start with you, let's talk a little bit about prices and where we're at with oil and gas prices. Gas prices obviously getting another boost overnight with this announcement by Ukraine that it's going to be shutting down one of the pipelines that brings Russian oil through its territory to Europe. So getting another boost there that wasn't necessarily needed. But on the oil price front, again, that's kind of getting a bit of support. But where are we with that? We've been in limbo for a week or two around this level. And what would you say would be the floor at this point in time?
Well, I don't know what the floor is, if there is such a thing. Nor for that matter where the ceiling might be. We are in a situation where the price moves up or down by pretty large amounts every day, often for no particular apparent reason. But we are in a situation now where it is becoming clearer that the sanctions that are being proposed and will be gradually introduced by the European Union in the next few months are going to have a material impact on Russia's exports of oil, and indeed natural gas and coal, and on the basis that that is going to happen, and you can decide that the shortfall is going to be 1 million barrels a day, 2, 3, 4 million barrels a day. You can run various numbers, but on the assumption that there is a significant shortfall of supply from Russia, the issue then arises: where do the alternative supplies come from? And that is where you get into quite tricky territory, because we know about the constraints on the OPEC countries in terms of spare capacity. We know the limitations on the growth of US shale production and the availability of oil from other sources. Meanwhile, the price has been more towards the lower end of the recent range that we've seen, partly because we've had the lockdowns in China, which has suppressed Chinese demand pretty dramatically. In April, one estimate I saw was that demand was about 1 million barrels a day lower than normal. We don't know how long and how severe the lockdowns will persist in China, but there will come a time when they are eased and their demand comes roaring back. And on the basis that their demand will come back and demand elsewhere will still be fairly resilient to higher prices, we run into an issue of demand growing and uncertainties on supply. Therefore, the direction of prices is more likely to be upwards.
Okay, Rustin, if we just go stick to price for now as well, and demand and supply. I mean, the tight supply argument still seems to be winning, if you like, despite all the demand destruction headlines and realities that we have on the ground, such as pending economic recession, China, as Neil just mentioned, a big factor in that. But the supply tightness equation does seem to be dominating, if you like, the challenge, I suppose, of the market at the moment. And yet, we have a news article there that says that all tanker rates are taking a bit of a hammering. Why is that if we're expecting, oil and oil prices to continue to be supported? What's your take on that at the moment?
Well, oil, freight rates for tankers are not predicated on price of oil. It's basically based on the amount of crude cargoes that are available to move versus the readily available amount of ships. Now, with the pending with the current self-sanctioning on Russian flows, there are a lot more ships now looking for oil cargoes to ship than there were pre-Russian invasion. So, of course, freight rates take a hit because you have more supply of freight than you have demand for cargoes. Now,
carry on. Sorry, yeah.
Yeah, from a price standpoint, I would say I'm probably the counterpoint to Neil. As I see the recessionary pressure and the inflationary pressure having a far bigger impact on demand destruction than the supply constraints. Because if we had the true supply constraint, and if you look at the market, it's been range bound between 100 and 110 for the better part of about 2 months now. And we've had the argument of supply constraints. We have the arguments of recession demand destruction. And when it gets to the $110 mark, the arguments for demand destruction become louder and louder. Prices drop down closer to 100. When we get closer to 100, now it's all of a sudden we're running out of supply, and markets move predictably right back up to 110. As we can already see today in today's price action, crude had dropped all the way down to $101 for Brent. It's now up to 105 on headline after headline of supply constraint, supply constraint, supply constraint. So, I mean, I think the market is still in this tug of war. I don't think either side has won yet. And, it's yet to be seen, do we have more recessionary pressure, keeping demand under control and destroying demand? We have riots in Sri Lanka. Pakistan looks like it's having some problems as well. You've had issues in West Africa where countries can't afford to buy jet to run planes intra-country. Interregional travel, concerns in the United States on the current higher price of gasoline, which they're now concerned about summer driving demand, which is a big demand factor in the United States for crude production and crude runs. Diesel demand destruction is already hitting the United States, and I think that's part of the reason why we haven't seen production increases in the United States, because that inlaid cost of diesel is up 48% from December to today, and that impacts not only the drillers' profit margin, but also the truckers and the suppliers of goods into the oil patch. So I think there is still going to be this yin and a yang, but I'm sure more of the demand destruction will have a far greater impact on prices than supply curtailments will here in the close near future.
Yeah, but on the product side, as you mentioned, one or two products there, gasoline and diesel. I mean, crude is, as you said, been in limbo in this 110 for 2 months, but product prices have been much tighter, and product flows obviously have been more impacted, let's say, by the conflict in Ukraine.
Well, it's not only the conflict in Ukraine, but it's also China made a conscious decision back in Q3 of last year to curtail crude imports and curtail refinery runs. China exports to the market, which were primarily distillates, are down 48% year on year. I mean, that's a huge amount of diesel that's not making it back into the market in Asia, which then pushed the Asian market lower, which then pushed all that extra distillate into the European space. So you have the double-edged sword of Russia self-sanctioning, China not running at its normal capacity for whatever internal demand reasons they want to give out to the marketplace. But nevertheless, it still keeps the market on a very tight product. And diesel is the industrial fuel driver of the world. And when you have $1,200 per ton diesel week, it hurts economic activity all around.
Laurie, let's talk a bit about those products and look at the Middle East, and not to get too technical, but there was a bit of discussion this week on our program that Middle Eastern refiners are well placed possibly to start taking up some of the slack of supply that's happening from elsewhere, out of China, etc. Are we in a situation where Middle East NOCs and refiners can do that in the immediate sense? There's obviously new capacity coming online soon, but where are we today in terms of products?
Not to talk about technical, because I don't know much about technicalities of that, but what I know that's about policies and directions in the Middle East, and a lot of the NOCs and a lot of the producing countries in their way of thinking what this energy transition will mean and what this loss in demand will mean. They tried to diversify, and diversify within the sector meant that to invest in petrochemicals and in refineries. And this is why many of the big producers like the UAE, Saudi Arabia, etc., wanted to invest in refineries and petrochemicals, etc., because they thought that that was the direct and easiest way to diversify, while they are diversifying the economy and going away from any kind of oil-related economy. But in the oil-related economy, this is where they're investing. And in this week, there were a lot of discussions about but when will these come to the market? We're talking about refineries functioning by next year, the year after, etc. So I think the Middle East knows where the future is going. They're trying part of diversifying, part of thinking of a strategy after within the energy transition. They're going to that trajectory. Will that have an effect now directly on what's happening? I'm not sure, but midterm, long term, definitely they are positioning themselves to be again on the refinery side, having a role to play.
Certainly, everyone is looking at this Russia in terms of Russian supply impact as a midterm, long term. Even if we have a resolution, no one is saying that Russia won't be sanctioned or continue to be restricted or at least monitored. But let's sticking, Laurie, with you and to supply and the region, and let's talk about Iran. What's happening there on the deal and the talks with the US? Again, taking a bit of a battering in terms of progress, and Iran perhaps feeling a bit more comfortable with oil prices where they are and kind of taking a stand. But where are we at with that? Are we going to see something given that both parties would like to see a deal, supposedly?
Look, I think at the beginning of the Ukraine war, there was this rush from the Americans to find alternatives. And one way, was they were they got excited again about the Iran deal, thinking that 2.5 million or something coming to the market will kind of help ease the prices, etc. But the Iranians knew that, and actually they had put more conditions that went into conditions that were a bit scary to the US and to the region, actually, Saudi Arabia, UAE, Israel, etc. That is related to the Revolutionary Guard, putting them off the terrorism list, etc. And knowing the role, the economic role that group plays. So it was, I think, a no-go or no starter for the Americans, or a turn-off. So my reading is, and the way we're going, it's like no deal will happen before the midterm elections. So after that, therefore, they're not looking for that. It's kind of a sign for that is like the Americans were in Libya a couple of days ago, right? So they were in Libya because they wanted to discuss with the Libyans, guys, what's happening there? Are you're shutting off political decisions, are shutting off the fields? We need extra barrels, we cannot take that. So are they going to be involved again in a political solution in Libya, so that they would see that increase in Libya, at least, if not like a tremendous increase, but at least not a decrease, or halting or stopping the fields from producing, etc. So I think we're in that direction when it comes to Iran deal. I don't see any.
So no extra Iranian oil till the end of the year, and what is there already is being factored into supply anyway. Neil, just on that front of supply again, and OPEC oil and OPEC plus, obviously we've got the Russia equation where that's being obviously that's limited to an extent now in terms of their production and the impact that sanctions are having there. We haven't though seen a lot of Russian oil missing from the market yet, right? It's been redirected. If it hasn't been taken by certain traders and shippers, it's being redirected to China, to India. When will we see an impact, putting sanctions aside that have not been put in place yet, oil sanctions by Europe, the payment system that's going to kick in supposedly and enforced by Russia, are we expecting any impact from that in terms of?
Well, we have actually already seen some fallback in shipments, seaborne shipments of Russian oil to Europe. It's not dramatic, you're quite right, because there are obviously existing contracts and logistical issues and all the rest of it. But there has been something of a pullback. But you're also right to say that there has been an increase in shipments of Russian oil to certain places in Africa and certain markets in Asia. And you mentioned India in your in your remarks. The other interesting thing, by the way, when you look at the seaborne data for Russian exports, is there's still small but noticeably growing proportion of Russian seaborne exports are leaving without a known destination. That oil is onto the water. It may end up in floating storage somewhere because nobody wants to buy it. Who knows? But it could well be that Russia will end up sitting on a lot of oil that nobody either wants or isn't allowed to buy. Could be a problem for them. India is interesting because for India, if you look at it purely in commercial terms, Russian oil is an unmissable deal, subject to quality considerations in terms of its compatibility with their refiners. But if you're looking at Urals priced roughly $30 or so a barrel below the Brent price, and you're a big importer and you're concerned about the impact on your economy of higher international oil prices, to take more oil from Russia is unmissable. And India has done that. I think in March, I haven't seen the most latest numbers, but from a relatively small base, because India wasn't taking a lot from Russia, I think they quadrupled their imports, something like 50 to 200,000 barrels a day, something like that. So for them, it's unmissable. China, slightly different because of the particular circumstances of their market right now. But Russia, the numbers are starting to come down, and I suspect that there will be a big acceleration. Meanwhile, because Russia will have a limited ability to export to Europe, that backs up through the system, and you end up shutting in production at home. And there's already some signs that that is happening, down by, depending on whose estimates you believe, about 1 million barrels a day or so already, and that's likely to accelerate as we move through the summer and as the sanctions start to bite.
Yeah, Rustin, in terms of sanctions, financial sanctions are already obviously in place on Russia, and then we have, as I just mentioned, that the payment mechanism system that Russia has insisted on, and where is it from the trading community perspective? Where is the point of view on that at the moment in terms of payment mechanism? There's two schools of thought that actually makes no difference. There's ways around it, or actually it's going to have a real impact, and Russia's going to get its way. But where are the traders sitting at the moment on that?
Well, I think traders publicly are making announcements to the fact that they're not going to engage in new contracts. They'll honor existing contracts, but not go into new contracts, for this year. However, Russian oil continues to flow. There are traders who are on the margin, who are in between the supplier and the seller. Oil is going to move out of Russia and get exported into the market. The floating storage will end up happening, but I think what we'll end up seeing is very much like what happens with Iranian crude. It gets washed through some type of lightering operation or some other location where it becomes re-BL'd and becomes a different crude, and then makes its way into the commercial marketplace. So to say that Russian oil, it's sanctioned, it's out of the market, is being a bit, say, loose with the term of being out of the market. It's just not going to be called Russian oil. I think when you look at it from a supply standpoint in Europe, Europe does have a very serious problem that you do have Russian oil companies that own significant refining capacity within the EU, and the supply of crude into those refineries. And what do you do with those refineries? You can't ring fence those or try to ring fence them and then shut them down, because then you just further starve the finished products that those refineries supply to major industrial areas around Europe. And you end up with even a worse recessionary impact than an oil embargo is going to have in the first place. So, I think the flows will still happen. China is still taking all the Cosimo flow. So that's still moving into China without much problem. And, I think things will move on. There will be a reduction, and it will happen.
Are we seeing, Rustin, the momentum for oil sanctions in Europe increasing or not? Is it losing some steam with a bit of opposition, obviously resistance from countries like Hungary, Slovakia, etc.? When will we see that? I know everyone's saying it's imminent, but what's going to make that happen?
Well, I think the EU sanctions are in a bit of a pickle at the moment. They've already started to water them down. They watered down the shipping regulation, where they've allowed, shipping companies that are shippers that are European owned and operated are going to be allowed to move Russian products. And that was basically a nod to the Greece and the Maltese delegates, who were putting a lot of pressure on the EU because shipping is a big part of their GDP and they need to have that market moving. And so now you have a watering down of the EU sanctions on shipping Russian cargoes. The embargo is going to be hard to come by, because you do have 4 countries that rely fully on Russian imports to maintain their energy balances. They can't afford to be shutting down their energy balances. The EU reached out to Hungary about giving financial assistance, but financial assistance doesn't turn the lights on in your house or put oil in your car. So, and there's also been some stories of unions pushing back against the German government because of the refiners that rely on Russian import crude. You're talking 1,200 workers from the Bavarian region that their refinery relies on 80% Russian crude imports to operate. And so are you going to start laying off industrial workers? And unions have a fairly large say in the matter. So I think it's going to be a harder thing for them to put together than people are anticipating.
Laurie, just to come back to the Middle East, and let's talk about the Gulf and OPEC producers. Saudi, UAE have been sort of seen to be the two within OPEC that today could possibly add a bit of supply if needed, and they've been holding back on that. Someone telling us yesterday that actually compared to 2-3 months ago, the capacity limitations have eased a bit there, and actually Saudi and UAE are better placed today to actually add supply if they could. Still seeing a lot of resistance from them though to do so. Why is that? Is that to support the price, the political? Where's that point of view right now?
I think they are happy with the prices, right? And you see in the news, like economy growing in Saudi Arabia, etc. And basically, most of it's because of the high oil prices. And again, we shouldn't forget that 2 years ago, it was a catastrophe. All these countries that were relying on oil and gas had a major economic issue because they've seen their revenues crash. So today, we don't say that they're not happy. Of course, they are happy with that price. And as long as people are ready to pay for that price of energy, they are happy to maintain that. And they will continue doing what it takes for that. So that's why I think yesterday we've been hearing again the ministers of energy in the UAE and Saudi Arabia saying that, guys, we have an investment problem. We need to continue investing in upstream. The way you are dealing with this situation now, it's in the wrong direction. You're blaming us, you're blaming OPEC plus, because we're not increasing as much as we want, etc. All of that. And they're saying, and they maintain what they're saying, that today it's all about geopolitics. It's not about demand or about supply, but soon we will have a supply problem. And this is something that they've been saying and saying and saying. They're saying that there is a huge need for investment, and soon we will end up with this problem where when demand comes back, where are you going to bring that supply? It's not enough like one or two countries like Saudi Arabia and UAE to keep on pushing for the demand that will come back. So I think that is something that we need to pay attention to it. And actually, even like we started this year, and I think most analysts were like in that direction, that this year was supposed to be to discuss about supply and do we need investment in new investment in upstream. And then, of course, with the Russia and Ukraine, everybody started talking about Russia and Ukraine, but the problem was supply, and they continue on that point. So I think that's why, and they're upset today that, again, the Americans very short-sightedly, because they're thinking of the November election, they're taking decisions like now discussing NOPEC, etc., and blaming the others just because they want to see that gasoline price going down. So they feel that this is not the right way. They're not looking at the longer, at a more of a holistic approach, but they're just thinking, the Americans thinking short term.
Neil, on that front of sort of has the conflict in Ukraine, shifted structurally sort of the whole energy security argument and planning for Europe? It's this conflict may end soon, but it has certainly highlighted those vulnerabilities, and again highlighted the lack of investment in upstream. How much is there going to be a fundamental restructuring now going forward, and is the energy transition going to slow down as a result? The Gulf has plenty of money to spend on both angles, if you like, but Europe is not so lucky.
Gosh, those are enormous questions. Let's try to be as brief as possible. I mean, for the Gulf producers, of course, happy days are here again. We're back to 2010 to 2014, when the price of Brent averaged almost exactly $100 a barrel throughout that whole period. And for them, as Laurie says, these higher prices, given what they went through in 2020, are a good thing. The oil minister of Saudi Arabia and his UAE counterpart were talking yesterday about the perils of the lack of investment that we've seen, not just very recently, but going back several years to the middle of the last decade when prices did collapse. And they're right to point that out, because eventually the dust will settle to some extent on the fallout from the Russia-Ukraine situation, and demand growth will resume. Well, it's obviously growing now, but demand growth in normal circumstances, shall we say, will resume as we move through the rest of the decade. So there is going to be a squeeze because there isn't enough investment, and this is now a chicken that's coming home to roost, and they're quite right to warn of the consequences of that. I felt this for a long time even when I was still working in the IEA. That you cannot ignore the here and now, while you're obviously looking to the future to decide on policies to ease the energy transition. Energy transition is important, of course it is. I believe it is important, but there is a here and now, and the here and now is looking distinctly uncomfortable. And if Russia is to be excommunicated from the European market, the US market, and other parts of the world, if it's going to be excommunicated for a significant period of time, then we have to do a lot of fresh thinking about new security arrangements and tackle this issue of investment in the upstream oil and gas sector.
Rustin, just to go to you, we haven't mentioned the word inflation in the last half an hour, which is obviously on top of everyone's mind. At the moment, we've seen what's happened in the last month with CPI figures. We've got US figures coming out again this week, and there's no stopping it. The Fed is doing what it's doing. It doesn't seem to be having too much impact yet. But let's talk about prices and commodity prices, obviously, that are being also fueled along with food and other consumer products. How worried should we be about the impact of the commodities getting much more expensive on emerging markets? And the forecast by all intents is that this is another super cycle and nothing's going to stop it.
I would tend to agree that, or disagree with that. It's just we're entering another super cycle. I mean, I think the inflationary pressures are going to curtail a super cycle. We're going to see a pullback before we have any restart of a super cycle. I wouldn't be surprised that by Q4, we have a much dramatically lower crude oil price akin to what happened in 2008 and 2018. When the markets went into a major recession, we had a wholesale collapse from $147 down to $30. I think that the demand destruction is going to be massive. It's already being felt. You have unrest, as I mentioned earlier, in a lot of developing nations because the price of energy, the price of commodities, and the soon-to-happen price of food is going to really put a lot of people into a distressed situation. I mean, you already have the UK developed nation talking about cost of living crisis and how they're trying to tackle the high cost of food and high cost of energy for their general populace. And that's just going to keep rolling on. I mean, I don't see how we get out of this inflated asset bubble until we actually get a retracement down, recession hits, revalue, and then we move forward.
And do you see that spreading to the US, or are we going to see it mostly emerging markets, economies, and Europe?
Well, I think if you look at it from a timeline, the way I have it in my mind is that it's going to hit the European Union first, and then it's going to roll into the United States. The European Union will probably slow down Q3, Q4, and then the US will probably be Q4, Q1. It will be a domino effect. I mean, it's all predicated on the fact that we've had inflationary pressure since the beginning of 2021 when freight rates went through the roof on containerized goods. Supply chains got dislocated with the COVID outbreaks. And now it just keeps on rolling forward. And so I don't see any relief here in the near future.
Irene, can you put up the poll result, please, for us? Sorry, I didn't have a chance to read it out to everybody, but I hope everyone saw it. A no deal on Iran, JCPOA talks would trigger a nuclear arms race in the Middle East. Agree or disagree? That's quite a close vote there, 54 to 46. Laurie, we'll go to you on that. That's a big question, obviously. But let's take a little bit a side question to that, if I can, and let's talk about Russia's role in the Middle East, and it could be influencing also the JCPOA talks behind the scenes as well. But its role in Syria and the Middle East, and obviously that's been built up in the last decade. Now it's distracted. But where do you see, once this conflict in Europe is over, do you see still a strong presence of Russian influence in the Middle East, given the US withdrawal, if you like, from the region?
Look, I think this is an interesting question to see how the outcome of the war will be. Is Russia going to be victorious in this war or not? And how Putin is going to be seen as a hero of that war or as someone that really destroyed the Russian economy, the position of Russia where they were. Like at one point, I remember we were discussing on this show, like saying that the way the Russia is positioned worldwide with economy, the position around the regions, etc. Why would he want to destroy that and go to war? For what reason? And Sean was the one saying that yes, he will do that. He will go to war. So it depends the outcome of the war and the position of Putin to see what will happen in the region and the role of Russia in the region. In this region, they don't like weak people. They don't like weak politicians, weak leaders. So if they feel that Putin is weak, they won't care. They won't care. So we'll have to wait and see on Russia's role in the region,
Neil,
especially in Syria and in Libya.
Thanks, Laurie. Neil, I'll give you the last word. Just to go back to China, you've mentioned it earlier in terms of demand, I suppose, and Rustin was just talking about that he's pretty sure this whole demand destruction equation is going to hit by Q3, Q4, Europe, and etc. elsewhere. China's obviously slowed down. It's got its COVID challenge. Some people are saying it's getting on top of that now, and it's kind of the beginning of the end of that challenge, if you like, and it's going to provide stimulus, etc., into its economy. How concerned should we be about the China demand equation? Are we going to see that, do you think, recover by the end of the year and provide support where elsewhere in the world we're not getting for the oil markets?
Well, China was the first country into lockdowns in 2020 for obvious reasons, because that's where the thing started. And China, at that time, as it's doing now, applied very, very aggressive lockdown measures, far tougher than would be possible in Europe, the US. Consequently, China was very fast out of lockdowns in 2020. So there was a very sharp V, if you like, the big dip, and then the fast recovery. Whether we're going to see the same thing again in 2022 is perhaps not quite so clear. But I suspect we will, because quite simply, there's only so much Chinese people can take. I've seen social media messaging in the last few days about physical barriers being constructed in streets to physically prevent anybody that had the nerve to go out of their building to try and go anywhere. They're almost like building the Berlin Wall. And it looks as if we could be in for a slightly longer haul in China than we might have thought. But when the measures are released, I suspect there will be a very, very strong rebound in China, even leaving aside, the pricing issues, which Rustin has talked about very eloquently this morning, and he's made some very, very important points about demand destruction. But China is going to come back, I think, fairly strongly once the lockdowns are eased.
Okay, well, thanks. I think we'll end on that positive note from China, again, coming in to save the day, maybe later this year in oil markets. Thank you very much, Neil Atkinson, Laurie Haytayan, and Rustin Edwards for joining us this morning, and have a good remainder of the week.
Thank you
very much.